morning, everybody. My name is Wasim Javed. I'm with Manning Elliott. With me, sharing my screen is Craig Smith. He's also with Manning Elliott, and virtually joining us is Prentice Durbin from Harper Gray. So we're here to talk about how to prepare to grow your business. We would like this session to be as interactive as possible while we're going through our slides. So if you come across something and you've got a question on your mind, just feel free to type it in the chat, and from time to time we'll keep looking there and see if we can answer it during our presentation, or whether we'll, if not, then we can always answer it afterwards during the Q&A. So is your business ready to grow? And what we mean by this is, are you ready to go to the next stage? You've got an idea, you've got, somewhat of an infrastructure, you've got some sort of a business plan in your mind. Now, are you ready to go to the next stage? Have you even incorporated your company? That's one of the things that Prentice is going to talk about later on. But what you, from our perspective, what we've seen, and now there's a lot of different things that you need to grow your business. But from a very high level, what we've got is, you want a business plan. Once you've got that paper down, then what you need is infrastructure. And after that, once you've got the infrastructure and the ability to generate significantly higher revenues that you have already, then what you need is marketing to be able to execute on that business plan and make use of your infrastructure. Now, all three of these things, even business plans, if you can do it yourself, or you could hire professionals to do this. A business plan, infrastructure, and marketing, all three of these things will need financing. How you come across the financing, now there's a couple of different avenues, and there's a few different people that you could approach. You could always approach your family and friends for some debt or equity financing. You could approach institutional lenders for debt financing. You could approach institutional investors for equity financing, or you could approach the general public for equity financing through, what is known as either an IPO, if you want to do that. Or you could have a combination of debt and equity. There's multiple instruments. We're not going to go as much into what all the or how to getting that financing, but what I'm trying to do is explain to you how to be prepared to take that next step and approach the financing option. So some of the prerequisites for financing that, no matter who you go to, even the friends and family, they would want to know some of this too, but more so the institutional side, or if you're going to go out there to the general public and try to do an IPO, what they're going to ask for is, whether you have a business plan or not. And then followed by that, what have you done so far? So they could either ask for audited financial statements, reviewed financial statements, or just, non-audited and non-reviewed financial statements. And then they're going to ask for forecasts. Now, all these three things, the business plan, you've got an idea, like I said, you could hire a professional to help you design a business plan and put it on paper. Forecasts and audited financial statements, you will need your internal and external professional accountant support for that. By external, it's the auditors that are going to review or audit your financial statements. By internal, it's your internal accounting department.
And just to add to that, in terms of forecasts are not necessarily going to be audited, but it's something the auditors place reliance on. So it's something that, as part of our audit procedures, we do look at. So if you're auditing your financial statements, it adds an element of credibility to your forecast as well.
Yeah. So the one thing I'm just going to zoom in on a bit is you will need an audit at some point, whether it's your shareholders, whether it's when you're approaching financing, And there are certain issues that we see from time to time when we're auditing a startup company or a new company for the first time. Sometimes these entities have been around for 4 or 5 years, even longer than that, but they don't have their accounting systems in place to allow them to have accurate financial statements which are ready to be audited. So, some of the common issues we've encountered during the audits are that the accounting is seen usually as an unnecessary function, which in the eyes of some doesn't lead to increased sales or production for the company. So it's never really the top of mind of the founders or management, and they're usually more focused on the short-term cash flow issue because they want to see, they want to survive, and they want to ensure that they can keep the business going.
As Wasim was saying there, it's a cash flow short-term focus, whereas your accounting standards require the accrual basis. So a lot of the time, founders of these businesses, they understand the cash flow, how to manage that, but that's not in line with the accounting standards. So when it comes to auditing, tends to be a lot of adjustments and work involved to move from a cash basis to an accrual basis.
So as a result of that, the accounting records and as a result of that, the financial statements are not usually complete. There's always missing information which is required under accounting standards that needs to be addressed. A very good example is what Craig was just referring to, is that the accounting standards require you to use the accrual basis. So a lot of times tax liability is not recognized on these financial statements, or accounts payable are not, because you're doing the accounting based on a cash basis and not accrual basis, but in fact those are your liabilities which pertain to that period. And if you don't record the liabilities, it means you're understating your net income. You're understating your expenses and overstating the income. Similarly, internal controls is another issue in startup companies or companies that haven't been audited before. Internal controls are not as strong. However, what happens is that this can lead to issues down the road. And what I mean by this is that by internal controls is you need to determine who places an order for equipment, who reviews and approves this order. As a result, who approves the invoice that comes in, and who ultimately signs the check. So ideally, there should be some sort of segregation deployed in this process to ensure that you've got some internal controls in place from a point of view of corporate governance.
And what founders tend to do is they'll say, okay, I'll take over the responsibility of signing the check, releasing a payment. But what happens before that stage? People enter into transactions to purchase or acquire assets or services. These things aren't authorized. It arrives at your door. Who's going to pay for it? I mean, the business entered into the transaction legally, and they've got an obligation to pay. So the founder is stuck to foot this bill, and he has no right to recourse against what has happened.
Yeah. So usually what happens when you have a lack of internal controls is that you end up having missing documentation. So sometimes and often actually, this ends up being the biggest hurdle in completing an audit on time. Otherwise, in other scenarios, if the controls are in place, the documentation for these transactions should be easy to find and provide to the auditors. In non-ideal circumstances, what happens is that sometimes we'll get the document the day before, the day before we've, our initial finalization date for the audit, and unfortunately, clients have this expectation that by simply sending in the document to the auditors or the outstanding documents to the auditors, whatever has been outstanding can be checked off. But there is a misconception that once that happens, the audit is complete. Unfortunately, as auditors, we still have to review all these documents. We have to go through to verify the transactions and assess, whether the accounting for these transactions was done for appropriately. So going back to the first point, on this, if the accounting department is not a priority for the management, then there are chances that the company didn't consider accounting implications of transactions appropriately, and as a result, incorrect application of standards can lead to significantly different results from what was initially presented to lenders or equity investors, potential equity investors.
I mean, this can go two ways. You could end up in a situation where you've under-recorded expenses and you think you're in to get an outstanding deal for your financing. But when you get your audited financials, standardized, you've got less profit, more expense than anticipated. Or it could be the other way, that you're expecting a small financing deal to come through, but after completion of the audit, your records could be looking more favorable, and you could actually access to more funding and more opportunities than you actually anticipated.
Yeah. So my last point on this slide here is that when an audit is rushed, it usually leads to inefficiencies because the correct information is not readily available, and we usually go around in circles to resolve issues. Also, when an audit is rushed, it's not the best use of everybody's time that's involved, from an auditor's point of view, and this does lead to higher costs for the completion of the audit.
Wasim, Craig, could I jump in for a minute there?
For sure.
Just coming back to, I'm sorry, there's some feedback coming through. It might be just a speaker. Anyway, pulling back to, you started talking about incorporation and these various steps of, growing the business and the varying levels of accounting involvement. And, Craig's bang on when he says, founder's going to take control of this section and write a check and the like. But there, very often it's cost prohibitive to jump to the audit stage. And Wasim mentioned that that investors or lenders or whoever may want to see, that the financials, the books have been looked after and prepared properly. But there's this interim period often in startups and as they start to grow, which is there's not enough money to have a proper audit. And, often the internal accounting team, might be a founder who may or may not have an accounting background, but they're just doing the best they can and they patch it together. In corporate law, all the shareholders need to actually approve the waiver of an audit. And we typically do this in the early stages where we circulate resolutions on an annual basis to waive the requirement for an audit. And the rationale there is that it's just not necessary at that time. As more sophisticated investors and lenders start entering into the mix, they'll require certain financial reporting, and that might be notice to reader. It could be a full audit. It could be, management statements on a monthly basis. It's really all about an information sharing and making sure that your investors are well aware of what management is doing, where the money's going. And that's really the crux of it, is that an investor wants to know that people aren't going out with, spending excessively on their expenses, cars or restaurants or something like that. They want to have a good understanding that the money that they've invested in your company is going to the right place. And that ties back into the business plan that Wasim was talking about earlier. Right, having a business plan that outlines what you're going to do with that investor's money is a very important part of the whole process. So anyway, a couple tidbits, guys, back to you. Oh, with mute.
There we go. Thanks, Prentice. So Prentice is right, when he mentions that, initially in the early stages, the audit is not likely to be a, an area where significant funds can be spent, or any, because you've got a startup company and you're trying to minimize costs as much as possible. And and we totally understand that. But what can be done is, at least implementing certain controls. And if those controls are in place, it could prevent a lot of issues down the road. So that's our recommendation to any founders, or management watching this, if startup companies.
I mean, as a firm, we don't only offer audit services. We manage Elliott, we're auditors and business advisors. So our doors are always open. We can always speak to people, understand what's going on in your business, and help make suggestions as to what you need in place, what is going to be the cornerstone for an audit in 2, 3, 4 years down the line. Just to make sure that even though you're not going through the audit stage at this point in time, that you have everything in place, that when you get to that stage requiring an audit, everything is ready.
Okay. So I talked about a number of issues that we encountered during the audit. Now, what is the impact of these on the actual contemplated financing, whether it's debt financing or equity financing? So, number one, if the audit takes longer to complete than expected initially, this could delay the completion of the financing. That goes without saying, and that could impact different companies differently. Some might be able to stay afloat. Hopefully, nobody's going into a financing situation in a very dire need. But there are times when sometimes the cash flows are not, our anticipated cash flows are not envisioned correctly, and then some companies may not be able to survive if the transactions are delayed significantly. The other thing is that if there are changes to what was initially presented to the financiers, or for example the brokers or agents, compared to what is presented in the audited financial statements, now these changes could result from significant changes to the financial statements due to the preliminary accounting not being correct. Then the terms, and that includes the amount of the financing, may end up changing. And there's that rare possibility also, but not impossible, that the transaction may not end up completing. So in order to avoid these pitfalls, and in order to avoid negative impacts on your financing, there are some steps that you could take ahead of time, and these include, I keep going back to implementing internal controls. We're not expecting internal audits to be carried out, in a smaller organization on a regular basis, but at least ensuring that there are some sort of internal controls or processes in place, and that those are being adhered to by everyone, including the founders or management and owners. So everybody has to adhere to these. Implement some sort of a financial reporting process. If you don't, even if you don't have an external auditor come in and audit your financial statements, consider at least contracting somebody to at least not review, but prepare your financial statements in accordance with some sort of acceptable accounting standards. And by internal financial reporting process, what I mean is ensuring that your internal accounting is done on a periodic, regular basis. So not at the end of 6 months and not at the end of the year, but more regularly, monthly, quarterly, so what your financial picture looks like as well, and so you could present that to somebody else as well. Consult with professional accountants. I've already gone over that. You don't have to consult with professional accountants, or, for example, Manning Elliott, just to have the audit done. We're business advisors, and we can do a lot more than just the audit, and we do that already for a number of clients as well. And I've already gone over this, but preparing the annual financial statements, whether these are audited, reviewed, or compilations and notice to readers, as Prentice mentioned earlier, and make sure that these are in accordance with acceptable accounting standards. Now, I'm going to pass on to Craig, and if you've got some sort of an internal financial reporting process in place, what Craig is going to talk about is really going to attract investors for you.
Thanks, everyone. So I've entitled my section here, Make Your Data Speak for You. And a lot of the time people think, having a proper accounting software system is essential. And you need a system in place. But, do you need the SAPs of the world or something from Oracle if you're a startup business? And the chances are that's just beyond what you need. It's very expensive, licensing, you need certain skills to use it. So you can always look at something such as Sage or QuickBooks. And these systems are a lot cheaper to implement, very easy to use. A lot of the audit firms, their staff's really skilled in using these things. So when it comes to doing the audits, we can get a backup of the accounting system and we can run our procedures directly from the backup over there. What is nice is that there's been other tools that have been evolving over the years. And ClickView is probably one of the founders in a system where you could link to a database or import an Excel dump, and then you can you build tables and you would click on a table and it would dive you deeper into your data. So you'd have very summarized information, such as your income statement. And what you could do is you could click on, say, your revenue line, and that would drill you down deep into what are your sources of revenue, the dates that revenue is generated, and things like that. ClickView was a bit complicated in how it operated, and it's also required to be operated on a particular device. They've now moved out to a cloud-based version called ClickSense, which can be operated remotely, more user-friendly, and Microsoft has delivered on their own versions of this, such as Power Pivot, Power BI, and another big company that's very powerful at this point in time is Tableau. Now, ClickSense, Tableau require licenses, so this is additional costs involved. But you could always look at a product like Power Pivot or Power BI. These are free systems that Microsoft allows you to use. There are restrictions in terms of how you can use it, but it's definitely great for building out graphs, data, tables, distributing data to people and things like that. So just on this slide, what I'm showing is how you can take a simple Excel table and present it in a visual manner. And this is a direct import or export from an accounting system, be it Sage or QuickBooks. You put it into a table, it's easier to digest, easier to understand. And I think the big thing that's happening nowadays is that, investors are not always the Warren Buffetts of the world. There's a lot of younger generation people investing in startup companies, and they like to see what is going on. I mean, a pie chart like this, just for me personally, is much more readable and understandable than looking at the table on the left-hand side. The other thing that you can do is you start build what we So you can also just build dashboards, and the dashboard brings a summary of all your data together. And this example that I've got over here is a whole collection of different data that you would not be able to understand just by looking at Excel spreadsheets. So I mean, on this page, you can see the number of stores that you've incorporated. You've got your total revenue for the year, but underneath that, you've got line charts that are showing you your revenue per month, comparing current year revenue to the prior year. And things like this is going to be greatly beneficial when you're financing, because if people looking to invest will be able to see, if you talk about, you had great sales in 1 month, they can see, is this just a once-off? Is it a trend where revenue's been growing historically, year on year, month on month? You can also show, where your revenue is being generated. You could overlay your revenue in states, within provinces, districts, regions. Just makes everything more visual. So you can understand that where your revenue is being generated, is it a risky area? Is it an area where you'd like your business to be? And again, this is all just data imported from Excel spreadsheets. And this is what Wasim was talking about, having your financial reporting process in place. By recording your transactions as and when they occur, complete details, descriptions, the date the transaction took place. who was the vendors involved. Just completely recording the transactions at the correct values and all available information allows you to be able to create tables like this. Just an example of some of the different types of visualizations you have available in Power BI. Comparisons, changing times, ranking, spatial flows. It's almost an endless world, and there's always being added to it. And to say, if you're using something such as a Power Pivot or a Power BI, a lot of this is actually free that you can use just with certain restrictions. Should you decide that your business is growing sufficiently, then you can acquire the licenses. And it's not like you have to change your system or your platform. It just enables more and more features. Just looking a little bit more detail into what we can present is on the top left of the screen, you've got what is referred to as a fish tank. Now, the size of the fish it can represent a volume, a value. The bigger the fish, the higher the number. Then there's the circular fish and the triangular fish. Now, each shape would represent a different product, a different service, and the fishes move up and down, and as sales occur or changes occur within the business, the fish will change size, they move the position in it. You can add different fish as you increase your product offering, and it becomes a very visual graph. I mean, whether you're sitting using this for potential investors or you're working within the business, trying to manage your costs and your income, you can look at these things. What I've seen happening with the fish tank is people looking at their expenses, and they'd have this as a home screen that they look at all the time. So, if a fish suddenly gets too big, it's like, well, what did we buy? What did we acquire? Why has this happened? So it's very easy to see these changes happening on a live basis. On the right of that fish tank, there's a spatial view, and this has been used extensively with coronavirus this year. You can see where there's areas that have significant infections. You can click into areas, you can drill down, see the number of infections that are happening, and get more detail. The map changes, the color changes to suit information you put in. So the brighter the red, the higher the red instance represents a higher number of infection rates. The darker the color, it means lower infection rates. So instead of trying to look at a table and understand, which is a risky area, what is a low risk area, you can look at this table and immediately you can see which areas, parts of Asia, the USA, they seem to be a brighter color, and it shows a high risk area. This doesn't have to be used, this can be used for your sales, same principle. If you switch out number of infections for a dollar value of sales or units sold, you'd have the same effect. You also get what they call slices, and the slicer is essentially a filter. So you can create a slicer for different products, you can use it for dates, and you can just move your slicer. If you're using a date slicer, you can just click month by month and you can see your actual financial results for that period. If you want to look at February, you click on February and it would filter out all the January and the rest of the year numbers and just show you what happened in February. So if you have an abnormality, it's quite easy. You click on that month and you can get the details. To the right of that, you get a correlation. This is actually called the SAN key, and it shows how transactions interact with each other. So it will take, if you're trying to do cost allocations, it will take the cost of a product and show how it flows on to the next product, back and forth, and you can actually trace where your expenses and everything is going. So this is some of the visualizations that's available, and it's that you don't need a complex accounting system such as a SAP or an Oracle. These things can be achieved with simple systems such as Sage and QuickBooks.
Okay, so we'll come back to this at the end, but over to you, Prentice.
Super. Thanks, Wasim. So my name is Prentice Durbin, and I'm a partner at the law firm of Harper Gray. We have a group that covers a whole bunch of different areas of corporate and commercial law, but I spend a lot of my time in the tech space. I co-chair our business law group with my colleague Steve Lucas, and Steve and I have been in the tech space for many years. I've included here a top 10 list that I'm sure that some folks have used before, but we can, I just plan to use that as something of a backup. I would like to just talk about a few items that have been brought up, but actually I should just check. Wasim, do I have control of that, or do you? Okay, so we'll go through this. Thanks. Just before we get onto the top 10, and feel free to do your drum rolls as we go. But a couple things that were mentioned about financing and debt and equity are the traditional two ways to get money into your company. But also wanted to make sure that we mention the non-dilutive funding from IRAP or SHRED or some of these government-sponsored programs where effectively you as a startup can, with a bona fide business plan or whatever the requirements are, get access to government funding that really comes in the form of a grant. In certain circumstances, you have to pay it back, but in most cases, it is forgiven or just been blessed by a grant. It's usually when you sell the company or move the company out of Canada that are the two big triggers on that one. We talked about, Wasim and Craig were talking a little bit about rounds of financing, and one of them is that we hear about is friends and family. And as we all know that we have family members that tend to scrutinize more than others. My view on the friends and family is really it's about blood money, and what I mean by that is that regardless of whether you succeed or fail, the family's still going to invite you over for dinner on Sunday, and they'll let bygones be bygones. So, true friends and family will be much more lenient, than some others. Okay, so just I'll cruise through this top 10 list. And by the way, I did see a note in the chat line about access to the PowerPoints. We've got our contact information. If you can't get them from the recording, then I'm sure that you can reach out to any one of us and we can share our respective slides. One of the first things that we need to think about is incorporating and when to incorporate and getting that underway. We all love our favorite names and come up with these great ideas for incorporating and using a name, but what often people don't do is actually just do a quick Google search and sort of look and see if there's a competitor, there's someone using your name, there's something like that. It can essentially lead to a whole increased marketing expense because you've got to rebrand. It has happened to one of my clients. They operated for a year with name A, only to find out in that year, after about 12 months, that there was virtually an identical company with a very similar name that had prior use, and it was going to be a problem. So they had to rebrand, which was not certainly in their plan and their budgeting or in their or certainly what they wanted to do. So that was sort of a pain. Okay, another drum roll for number 9, and this is really about sweeping things under the rug, if you will, not really dealing with legal issues as they come up in real time. It's easy to sort of push off some things, and a good example might be a founder that was all in at the beginning, but maybe decides they back out, or maybe they win a lottery ticket and decide to leave the workforce altogether. These things do happen, and for a lot of tech companies, the important aspect is, or the important asset is the IP and whatever a founder, for example, has created. And so it's important to make sure that founders or employees have assigned their IP to the company and that you've dealt with it then. Or if someone leaves, that you've got a release or some other evidence that the company owns the IP and that person doesn't have a claim to it. It's it's the same issue or a very similar issue to what Craig was talking about in terms of having your financial books and records cleaned up and organized. Well, and Wasim was mentioning it too. Whenever yeah.
And just talking about, you mentioned RP, a lot of times people have this belief that, you know, all the money they've spent on developing the RP can be capitalized, can be sitting in their financial records. And it should be in the financial records, but it's not always a balance sheet capitalized asset. A lot of the times it's actually an expense because they haven't met certain criteria. So they build this up, and they think they've got this significant asset or value. But in terms of the accounting standards, it actually says, well, up until this point, that was not adding value. It had no future benefits. Expense it. You end up with a smaller number on your balance sheet. And again, this just impacts what you as the business founder, the business starter, the perceived value that you actually created.
Right on. Thanks, Craig. Yeah, and where I was going before, just on this, you know, preparation and organization, is it's all about thinking about that next turn. You're going to grow to that next stage. You're going to have an investor that comes in that's going to look at your books and they want to see things organized. You know, it's like the present or the gift. It's got a nice bow around the box and it's organized and it looks pretty. Well, essentially, that's what we need to be thinking about as we go through these various phases, because the better you look, the smoother the transaction is, the easier it is to get the money into your company, the easier it is to close the deal, the faster you can close the deal. You know, going to the extent of audited financial statements, you know, if you're already audited, like, it's done. So, you know, all of these little things are just sort of, you got to keep them in mind as you're working through and engaging with each party or each aspect of the business. So the next one, number 8, sort of ties into this one as well. And it's about properly engaging employees. And again, it's creating this pretty package to present to an investor. You know, do we have employment agreements? By operation of law in Canada, an employee creates, and that creation is the company property. But time and time again, I'm in the middle of a cross-border deal right now with a US purchaser. And in the US, they like to see active language of assigning all your right, title, and interest in the works to the company. So companies tend to, you know, overlook this one. Yeah, I've got a one-pager, signed you up, I pay you a few $1,000s a month, you're going to get some options, life is good. But it's this other component of it about assigning to the company, waiving moral rights, and even just having a contract itself often is overlooked. So that's an important one. Okay, number 7, failing to properly consider tax issues. You know, when we're setting up a company and when we're planning for this growth, really in my mind, even when we incorporate, my question is, okay, when and how are we going to exit? What's your strategy there? And if you don't ask the question, it's just, it sort of gets overlooked. There's all sorts of different ways to hold the shares. The most common are by, you know, individual, or maybe there's a family trust, and there are all sorts of rules around, you know, how to use trust, because it's becoming, you know, slightly more onerous to deal with them. But the idea is really setting yourself up for understanding what the tax consequences will be to you on an exit. And, you know, what's important again is that, you know, what we're looking at is making sure that you as the founder or an early shareholder are able to take advantage of the lifetime capital gains exemption. And so we think about that right from the start, and we think about who should hold the shares and how they're going to be held and for how long they're going to be held before that exit event. So,
and just,
yeah,
as Brent was saying, you look at exiting the business. How do you exit? What you're going to do? And having good financial reporting procedures, good internal controls, that also adds to the exit process, because people aren't always buying your product or the idea. They're trying to buy the entire package. They want to step in and be able to manage this business as it was. They don't want to have to always rebuild and start over from scratch. They're buying something that's operational and want to take it forward. So, good internal controls, reporting processes are all going to add to this package.
Super. Yeah, thanks, Craig. Number 6, little drum roll. Failing to find the right angel is number 6. And so this is after friends and family, but before in an institutional investor. And I'm using this example just in a sort of classic framework for rounds of investing. So the founders have set up their company, friends and families next, angels would be third, a venture capitalist would be fourth. But the point of this slide is really just about angel investors can be extremely helpful to you in your business. And so finding the right angel is more than just who's going to give me a check, but who's going to help me with the next phase, who's going to help me with my business plan, who's going to help me, whether it's once a week phone calls just to sort of help keep me in line and on the right track, but who's going to provide that valued advice. And so that person can add in a variety of ways. It could be along the lines of understanding finance and investment and corporate governance, but it also could be a completely different angle, just being business and industry and experience in the marketplace. So that's that. Let's go to 5. We'll keep cruising through here. Failing to comply with securities laws. Even a simple promissory note is a security, and we get money into the company however we can. We often, as founders, will lend money into the company, and we lend it so that we can pull it out tax-free. But that in itself, because the company's issued this promissory note, which is a security, there is an exemption for it. Now, it doesn't mean a whole bunch of paperwork by any means, but it just does mean that you just got to be conscious of, okay, well, what am I issuing to this person? Is it a share? Is it an option? Is it a prom note? Is it a right to participate in profits? These are all securities, and you have to qualify to do it. And
the short of a combination of everything you've said as well, which makes the instrument even more complicated.
That's right. Yeah, no, it could be all sorts of things with convertible features and the like. But the idea really is just keep in mind that you need to comply with the securities laws. It can be as simple as a 5-minute call to your counsel, to your lawyer, just to make sure you're in compliance. But what you don't want to do is be standing on the street corner on a soapbox selling securities, because that's not allowed. The exemptions, think about it, friends and family is one, directors, employees, officers. Accredited investor is very common when we get to the angel round. So just make sure that you sort of comply with those things, because you don't want to be caught offside.
And just from an accounting point of view, is a lot of the time you issue an instrument and you believe that you're actually raising debt. But from an accounting point of view, it could actually be equity, or you may be issuing instruments that you believe is equity, but somewhere down the line, you've got this contractual obligation to either pay over interest or repay the invested money, and you've got a liability. And when you set this up, you didn't envision this, and it can completely change the structure of your balance sheet.
Mm-hmm. Yeah. I'm going to take a pause here for a second, because I see a question in the chat room just about employees and salaries and how do we deal with all this stuff during our interesting world that we now live in with COVID. So I've got a caveat that I'm not an employment lawyer. So this is an awkward one. In some companies have taken the approach that there has been extreme uncertainty and have made the unilateral decision to cut employees back. In the circumstances, it's been fair and prudent, and with a vision of long-term. We're just looking long-term, how we're going to weather this storm in the short term. So companies have cut their salaries back to their employees. Some have, trued up because they've weathered the storm or what have you. But it's it's an important one. I think the circumstances vary with each company and their respective employees and their arrangements. So I think it's not a clear-cut answer. You should go get some help on that one just to make sure that you're not offside. But in terms of negotiating, there's a reality that if there is no cash to pay people, what are you going to do? And you've got to sort of deal with that. And that's why some of those, the federal programs have been put in place. Okay, number 4, protecting IP or failure to protect intellectual property. Again, this is another important one, and it ties in a little bit with what I was saying before about the employment agreements, a departing founder, making sure that things are actually, or the IP or the asset, whatever it may be, is actually vested in and assigned to the company. So loose ends are not good. Investors want to make sure that what they're investing in is what they think they're investing in. So that's where the due diligence comes, to follow the bouncing ball, figure out where everybody has assigned their IP, for example, that they should have assigned. Number 3, this is always a good one, because this is all about the co-founders and what their agreements. It's always easy when there's just one founder, because then they can, beat to their own drum. But as soon as we have more than one co-founder, we need to figure out, what their relationship is amongst them. And all too often at the beginning, in the honeymoon phase, everybody's just, delighted and happy with starting up their new company, and there's excitement, and, they're ready to conquer the world. But, what happens if? And so we have, we commonly use certain mechanics to try to keep everybody honest. As an example, 2 co-founders each give themselves 50% of the company. And they give themselves 50% of the company at a very cheap price. The whole premise of that sweat equity, as we call it, the idea is that founder is going to stick around for a while. And so we put agreements in place with co-founders that basically hold them to that. And for example, we call them reverse vesting agreements, but essentially we say the longer you stay, the more of those shares you actually get to keep. And if you leave early, the company gets to buy them back for that, penny a share. And that sort of tends to keep people honest. The other one is, especially in a 50-50 scenario, unfortunately, personalities get in the way of these things, and we got to figure out how to separate if we need to. And so a very common arrangement is to have a shotgun clause. That's a whole other topic we can get into on another time. Number 2, failing to keep up your corporate records. And this is really, we've talked a little bit about the IP assignment and founders and reverse vesting and other things, but every year, a company is a creature of statute. It is a person in the eyes of the laws, in the law, and a corporation can sign contracts. It can borrow money. It can lend money. It can own property. It can, do everything you and I can, but it's all a process or created through the Business Corporations Act. Every year, the shareholders have to get together and vote on a few things. And what often happens is shareholders maybe, don't show up, don't sign a resolution. The founder just leaves it. This is one of those, legal issues that aren't dealt with on a timely basis. But every year, the shareholders have to sort of breathe life into the company again. And they do that at an annual general meeting. They do a couple of votes and you move on. But that in itself is keeping your corporate records up to date. And it's really important that you do so. So when you're working through it and lawyers like my office and the others around town, we have these systems in place so that you don't have to worry about that as the co-founder. Every year you get sort of a few documents sent to you that say, okay, it's time for your annual meeting. We're going to do it by signature, sign up, and away we go, and it's done. But often people sort of forget to do that. They forget to file their annual report. And suddenly you've got an IRAP loan, or you're applying for one, and you discover that your company's not in good standing. and you go like, oh, what's going on? We can remedy these things, but it's just better to stay on it so you don't have those surprises, because it's a little embarrassing when you go to IRAP or whoever and say, okay, I'm ready, and they say, oh, actually you're not. You got to get your house in order. So keep up the corporate records. And the number one, big drum roll, is get the right legal team to help you out. Many of us in town spend a lot of time in this space, and so understand it. The mom or dad's estate lawyer is very often not in tune with how to set up these companies. So just get the right person. It's I don't do real estate law, for example, so I don't try to do that, but I do tech companies. So it's important to get the right legal team behind you, team that you trust and that you can work with for a long time. So I encourage you to do so. So that's a top 10 to digest and think about, and great to see everybody here. So Craig, Wasim, you guys have anything else there?
I see there's a question from Jeff asking what is the reasonable percentage for a company to charge. And as an audit firm, we typically refer to this as contingency fees. It's something we're not actually allowed to charge. Using a percentage, it allows room for manipulation. Is it a percentage of profit, percentage of turnover? And you could end up getting incorrect advice that's looking short term, and it's not good for anyone. So we typically charge either a fixed fee that we've agreed on upfront or an hourly rate. So the best advice would be to actually get in contact with the firm, discuss what your needs are. The firm can put forward some suggestions, and work towards a package that suits exactly what you need.
Yeah, I think from the professional advisor standpoint, I totally agree. I think there's another component to that too, which Jeff might be referring to, which is sort of that advisory board. So a company will have a board of directors, but they'll have this advisory board, which are sort of, industry expert types that are not professional advisors. They are, maybe they've had a startup of their own and had a great win, and now they're doing some angel investing and the like. So in that case, it's negotiable, and I think that 1% might be the right number, Jeff. I think it really depends on the value add and how much you're using them, but I think that that's certainly a starting point. Many of the folks in that role will tell you flat out what it's going to be, so sometimes you don't necessarily have a choice, but in that range, it's typically lower than what your CEO or maybe the directors might be entitled to, but high enough to keep them interested. And an advisor like that, they're only going to get, many of them will only accept a few options. They don't command a salary or something like that. So I think that's where he's coming from there.